Good evening to all of you. Welcome to our class today. You can all hear me and hear me well.
Yes.
Okay, great. Now, the last thing we were discussing on risk and return, isn't it? If I remember.
Yes.
Okay, risk and return. Now, okay, I should do one. Let's do one or two examples on the risk and return before we introduce this new topic. Okay, and our new topic is on the appraisal of investment or investment decision making. That is our next topic. But I suppose I think if we do another example, then that should be good for all of us. How many examples do you do from CASNEP? How many examples from the past paper have we done on the risk and return?
We did November 2018, question 5.
November 2018, question 5. Okay.
Yes.
Let's take it out. Question 5C. Okay. Which other question have we done?
I didn't write the title, but it was under portfolio calculation of portfolio.
That is okay.
The return of portfolio.
Okay, the return of portfolio.
Let me check for you the question. Which year was it?
Okay, let's check. Sorry, I've not done.
It's the same question.
It was the same question on the 2018, the 2018 city. If it is the same question, then let me look for.
Yeah, it is the same question.
The same question.
Yes.
Okay. We can do a quick one here. November 2015, question 5D. Okay, you can check that out. November 2015, question 5D. November 2018, question 5, part D. Okay, we can go through it quickly and we attempt it. November 2015, question 5, part D. November 2015, question 5, part D. Okay, so in that sitting, you are being asked to get the coefficient of variation, okay, assessing the risk level associated with the investment, okay. So we need to make an evaluation of the coefficient of variation, okay. So first we need to get the return, and of course we need to get the risk, okay. So because therefore the return of this investment, okay, the mean return or the return expected, okay, the return expected from this expected return from this investment, okay, you told that you can get 40% return, but only 20% of the time, okay, you can get 15% return, but only 60% of the time. You can also get negative 10, can get a loss of 10, but only 20% of the time. So therefore, on average basis, what will be the return expected from this investment? Confirm.
It's correct. It's correct.
Yeah, we get a mean return of 15% from this investment, a mean return of 15%. Then of course we need to get the risk. Okay, we need to get therefore the standard deviation of this this investment. Okay, don't forget the coefficient of variation. Okay, if you still remember. Okay, whether I still have my notes with me. We did that. I think I gave you these formulas, if I remember. Yes, this is the notes I gave you, isn't it? Standard deviation, covariance, how to get coefficients of correlation between the two stock, coefficient of variation. I gave you these notes, isn't it?
Yes.
Yes.
Fair enough. Okay.
Yes.
Okay, great. Okay, so therefore coefficient variation, log it is the amount of for every return that you're going to be receiving, okay, for every return you're going to be receiving, how much risk does it come with, okay? Therefore, it's simply like a risk, it's the return to be received, it's risk per return, okay? That's another way of trying to call it, is risk per return, okay? So since this is risk and return, we have got the return, so we need to get now the risk, okay? Therefore, the risk here, we are going to measure it as we are going to use the standard deviation, okay, against the standard deviation. Therefore, okay, this is probability, this is from the data we have here is probability distribution. Therefore, the variance, okay, the variance, okay, of this particular data will be equal to sum of probability times deviation squared. Deviation will give me the return minus the mean return squared. Okay, from the first data set, in this case, all the way to the third data set. Well, there are three of them. Okay. If we can get the deviation times probability, so you have here boom, what we call this is outcome. Okay, this is just economic condition. Economic condition is boom. I have average and I have recession. Okay, the return, the probability there. Okay, we've done 0.2, 0.6, 0.2. The return they are expected, the return to be received, they are 40%, 15, and negative 10%. Then probability times the return deviation squared. Probability 0.2. The return here is 40%. I prefer to use decimals. You can use percentages in case you want. Minus the mean return, and the mean return you got to 15%, 0.15 squared. And here we have 0.6, the probability, times the deviation 15, 0.1 minus 0.15 squared, which will give us a 0. Then here I have 0.2 times deviation squared, negative 0.1 minus 0.15, the mean, squared. And get the sum. What the sum? Sum is going to give us the variance.
Zero 0.025.
0.025, that way.
Yes.
Okay, we get a variance of
Someone can confirm.
confirm, someone confirm.
It's correct, 0.025.
We get a variance of 0.025. Therefore, standard deviation, don't forget the square root of the variance, standard deviation. And the square root of the variance, 0.025. And you get how much?
Zero 0.158.
0.158.
Yes.
Okay, therefore, in percent, that'll give you therefore 15.8% to be the standard deviation. 15.8 to be the standard deviation. Okay, so having done that, we can now get therefore the coefficient of variation. Okay, can get therefore coefficient of variation. And you say this is the amount of risk per return to be earned. So it's going to get is the risk standard deviation. We divide by return. The standard deviation, we divide by the mean term. We divide by the return expected. Return expected. Expected return. Standard deviation, 15.8%. The mean return, we got 15 if I remember. Yes, we have it here, 15. So we divide by 15 and get 1 point.
1.053.
As 1.05. Okay, 1.05 comes for the coefficient of variation for this particular stock. Okay, for this particular the investment the company is choosing. The shares. Yeah, okay, they are shares. Okay, but for every return the company will be receiving, they will expose themselves to 1.05 units of risk. Okay, which is quite high by the way. The return actually is lower than even the risk. Okay, so that's for that particular stock. Okay. I would also want us to do another example. Let me see if we got one here. Okay, I don't think you have this. So let me share this question with you on the WhatsApp platform. So check it out. It's a question that is asking us about how to get the return on the risk for portfolio. Okay, so I'm sharing it on the group. Okay, I've shared it on the group. So go through it in the next. Actually, attempt it first. Attempt it first. Let me see how far you can go. Attempt it first. But it's simply applying the formula. There's nothing strange about it. So go through it, then attempt first, then we try to do it together after you make the attempt. So the example here is asking you to get the return of the portfolio and to get the risk of the portfolio. This is quite pretty easy. That's why I'm very surprised that you guys are struggling to get the answer. Anyway, so the company has invested 4 million in C out of 10 million. So it's 4 million out of the total 10 million. Therefore, the weight of C is 0.4. In S, the company has invested 6 million out of the 10 million. Therefore, 0.6. And you took the return for C is 11%, return for S is 25%. Therefore, the portfolio return, therefore, will be the weight of C times the return of C plus weight of S times the return of S to give us weight of C 0.4. The return of C, you've been told, is equal to 11%. Weight of S is 0.6. And the return of S individually is equal to 25%. Therefore, what's the return of the portfolio? 19.4?
Yes.
Okay, 19.4%. Then, of course, we need to get the risk of the portfolio. Okay, so the return is quite straightforward. Okay, the risk of the portfolio, say here, see, the risk of the portfolio risk, so it is given us, let me just open a new tab here. Okay, the risk of the portfolio is given us, variance is equal to weight of asset C squared, the variance of asset C, okay, plus weight of asset S squared, variance of asset S, plus 2 weight of asset C, weight of asset S, covariance between C and S. Don't forget, covariance between C and S is equal to, again, it is given us, or rather, the coefficient of correlation, between C and S is given us, covariance between C and S, we divide by the product of the standard deviation, okay, variance, standard deviation of C times standard deviation of S. Would imply, therefore, covariance between C and S is equal to, just cross multiply, is the coefficient correlation between C and S times standard deviation of C, standard deviation of S. Okay. Therefore, we can just simply plug in, okay, from formula here. Okay. Therefore, the variance of the portfolio is equal to weight of C 0.4 squared times the variance of C. We have been given standard deviation, so of course to get the variance we just square, which is equal to C is 0.15 squared. Don't forget this variance. This is variance, okay, plus weight of asset S squared times standard deviation, times the variance of asset S, 0.2 squared, plus 2 weight of asset C, 0.4, weight of asset S, 0.6, times covariance between C and S, okay, which is here. You've been given, we have it here, okay, which is equal to coefficient correlation between C and S, 0.3, times standard deviation of C, which is C is 0.15, times standard deviation of S, which you have here, which is 0.2. And you get how much? And of course, once you get the answer, you get the square root. Therefore, what is the standard deviation of the portfolio?
.149.
149. So more or less like 14.9%.
Yes.
Okay. So Michael, check your answer, and the rest was they work it out. I know the answer, but I doubt that 40% is just a bit too high. 40 points. Not sure. Is that standard deviation or what is that 40 point?
Standard deviation.
That is very high. Check your answers again. Because if you look at the individual assets, the standard deviation for C is 15%, for S is 20%. So it can't be beyond the two. It can't be beyond 20%, neither can it can't be beyond 20% for sure. You look at the individual asset themselves, you can see this is 15, this is 20, so it can't be 20. Check again.
Okay.
From standard 14.94, yeah, that sounds more or less close to the answer.
It's realistic. Yeah.
Yeah, that sounds a bit more realistic. Appraisal of investment, okay? Investment appraisal. So the idea here in this particular topic is, as a company, they do have to make long-term decisions regarding where they will be investing their money, okay, which projects should the company invest its money in, what should be the return the company expect to receive from this long-term investment, okay. So essentially, when it comes to the investment appraisal, okay, which again we subdivide in two categories: investment decision 1 and investment decision 2. Okay, just for our own class analysis. When it comes to the investment appraisal, okay, we are still going to be evaluating some potential long-term projects, okay, and it's upon us, okay, as the finance persons, okay, to advise the management, to advise the company that this particular investment you want to choose is going to be value adding because of A, B, C, and D. Or this particular investment you want to choose might not be a good investment for the company. Why? Because the company will be losing money. Okay, so it's upon us now to make the advice. Okay, to do what we call the financial analysis bit of the project. Okay. So in this topic, we shall be discussing what are the different methods we can use when it comes to the appraisal of the investment. What are the different methods we can use when it comes to the analysis, okay? Trying to estimate, okay, whether it's a good investment or it's a bad investment for the company, okay? That's what we're discussing in this particular topic, okay? And the methods we'll be using, okay, allow me to just fast forward. So the methods you'll be using, you're going to classify them in two main categories. Okay, the methods you'll be using, okay, the appraisal, investment appraisal. Something referred to as the capital budgeting decisions. Okay, it means one and the same thing. Okay. Okay, so the method we're going to be using when it comes to the decision making, the investment decision making. Okay, we have the discounted cash flow techniques, discounted cash flow techniques. And you have the so-called the non-discounted cash flow techniques. The non-discounted cash flow techniques. Now the key distinction between the two methods, okay, as you can see in detail later on, is simply, as the name suggests here, one is discounted, the other is not discounted, okay. What that implies that when it comes to appraisal using the discounted cash flow, we are going to be discounting the cash flow. We're going to be using the present values of the cash flow, okay. So if, for example, you'll be receiving money in 3 years' time, okay, we don't use the cash flows at the value as a tier 3. We're going to determine what is the current value of the cash flow to be received 3 years from now, okay. So we discount it back, we get the present value for the cash flows. So even if you're going to get money in 20 years' time, you discount it, you get the present value of that cash flow in today's time, okay. A simple example, okay, the worth of cash today, okay, is not the same that it was 10 years ago, okay, there's a difference, okay, we'll call the time value of money, okay. If you do a simple comparison of a product you used to buy, okay, 10 years ago, okay, and the same comparison, same product today, okay, how much do you pay for it? Okay, by default, you pay more than you used to pay for the same product 10 years ago, okay, because of the loss of value of money. So when it comes to the discounted cash flow techniques, we need to consider, okay, we need to appreciate the fact that money loses value across time, okay, so we ought to consider that we need to discount the cash flow, get the present value of the cash flows, okay. When it comes to the case of the non-discounted cash flow techniques, okay, what happens is that we are going to be making an evaluation. Okay? We are going to be evaluating the project, okay, without the need for us getting the present value. We don't need to discount, okay? That's called non-discounted. We don't need to discount the cash flows, okay, when it comes to the appraisal of that investment. If the money is going to be received in 10 years' time, it will be, let's say, 3 million. We use as it is, okay? We don't need to get its current value. We're going to be using the cash as it is without the need for us to discount back to year zero, get the present value of that cash flow. We don't need to do that, okay? When it comes to the discounted cash flow techniques, you're going to be using 3 methods, okay? We're going to use what's called the net present value, NPV. Going to use another method called the internal rate of return, IRR, and you have these of discounted payback. Then in the case of non-discounted cash flow techniques, you're going to use 2 methods. We have payback period. Okay, this is called discounted payback period. This is discounted payback period, and this one is payback period. It's not discounted, but simply payback period. Then you have another method called the use of the accounting rate of return. Okay, ARR. Somebody referred to as return on capital employed. Rose. Okay, so those are the 5 methods you're going to be using when it comes to discount, when it comes to getting making decision, okay, as to whether as a company we should invest in a project or not invest in a project. Okay, if I was to just appreciate, okay, the payback period, okay, is simply how long do you take as a company to get back your initial investment. You did invest in a machine costing 10 million, okay? How long do you take to get that 10 million back from the cash flow that to be generated from the investment, okay? So you invested 2 million in a project, okay, in a plant, okay, in a building, okay. How long do you take, okay, to get back that 10 million, to get that back 2 million, okay? So it's the length of time that it will take, okay, for you as a company to get money to get money equivalent to the amount you spent on that particular project, okay? So how long do you take to get back what you did invest in the project? That we refer to as the payback period, okay? In case you're going to be assessing the payback, however, you're going to be assessing the payback using discounted cash flows that we refer to as the discounted payback period, okay? Discounted payback period, okay? And so the distinction is simply, have you discounted the cash flow, okay? Or have you used them as you receive them, okay? Without the need for you to get the current value of those cash flow, okay? If we have used them as they are, without the need to get the current value of those cash flows, then we simply refer to it as payback period, okay? If the cash is discounted, that's called the discounted payback period, okay? Then you have called the accounting rate of return, okay? The accounting rate of return or the return on capital employed, okay? So here we simply make an evaluation, okay? From the investment, how much profit do you make? Okay, over the life of the investment, on average basis, how much profit do you make? Okay, so simply given us the average profit you'll be received from the investment. Okay, we divide by the average investment. Okay, so average profit divided by average investment. Okay, of course you express as a percent. Okay, that's called the return on capital. It is how much profit does every sharing of investment make for the company. Okay. It's how much did you invest? 10 million. How much profit does that 10 million make for the company? Refer to as the return on capital you have employed, you have invested in the project. Okay. Then you have the method called the NPV, net present value. For the NPV, net present, as the name is suggesting, net present. So we compare how much cash do you get? Okay, what's the present value? Okay, what's the current value of all the cash you'll be receiving from this project over its entire life? Okay, so it's the present value of cash inflows or cash flow from the project. Okay, we compare that with how much do you invest? Okay, how much do you invest in this project? What was your initial investment? Okay, we minus the initial investment. Okay, the initial cost. In short, the NPV, okay, is the excess of cash you'll be receiving from the project in present value terms over what you spent. Okay, that's what we're referring to. That's why we are referring to it as net. Okay, we are comparing how much cash do you get? 10 million. How much did you invest in this project? 7.5 million. What's the excess? It's 10 million minus 7.5 million. Net present value. Okay. Now now to get these present values, okay, of course we discount them. Okay, we use a discounting rate. Okay, now IRR is the discounting rate that is going to make sure that the present value of cash flow is equal to the initial cost. Okay, the present value of cash flow is equal to initial cost. So the rate we use to discount these cash flows that is going to ensure that we have this equation that present value of cash flow is equal to the initial investment cost. That discount is called referred to as the IRR. Okay. And this is just fast forward, okay, of what they say on this particular topic expects of us. Okay. So we shall discuss each of these methods in its own subtopic. Okay. But of course, the key thing here is not about the method. This method are very easy actually to apply. The issue is on the cash flow. How do you get the cash flow? That's where we have the issue. How do you get the cash flow? Okay, therefore we shall revisit, okay, the concept of relevant and irrelevant cash flow, relevant and irrelevant revenues, relevant and irrelevant costs. Okay, so we shall be referring back to what we discussed in management accounting. Okay, anyway, let's go back to the topic. So generally, maybe just to make an introduction, okay, that's when it comes to the investment decision, when it comes to the capital budgeting decisions, okay, what we are considering is capital expenditures, okay, those expenditures you incur as a business, as a company, with the future prospects that you're going to be earning from it in future, okay. We are not investing for the next 1 week, the next 1 month, okay. The return that we are anticipating to receive from this investment, okay, stretches beyond 1 year. Okay, they go beyond 1 financial year. Okay, that's the idea here. That's what they call capital decision, or capital budgeting decision. Okay, of course we have what we call the revenue expenditures. Okay, which you spend generally to sustain the company operation. Okay, paying your employees, paying for raw material, okay, paying for your bills, paying for water, for electricity. Those are revenue expenditures, okay, which of course you do incur so that you can sustain the company operations, okay. So generally, we are not going to consider that in this. We are dealing with capital expenditure. It's capital budgeting decisions, okay. And of course, capital expenditures, I think you have done them in accounting, how you account for them. Okay, I think you've done how you account for them as per 16. Okay, how do you account for capital expenditures? Okay, of course, again, to recognize them as part of the company non-current assets. Okay, and of course, every year you're going to be spreading the cost to the P&L or through the P&L. Okay, as form of amortization or through depreciation. Okay, of course, we charge to every year a depreciation amount of the amount you spend to acquire the asset. Okay. And of course, as I mentioned, this is what we're going to be appraising. Okay, the appraisal applies to the capital expenditures. Okay, so all capital expenditures, okay, therefore they need to be appraised. You need to do the evaluation as to whether they are to be incurred or not. Okay. The expenditure, of course, as mentioned, the adjustment you incur them to sustain the company operation. Okay, to sustain the company operations. Okay. And of course, how do we charge them? We charge them to the P&L, okay, as part of the company costs. Okay, so you just charge them as part of the company expenses for that particular time period. Okay, therefore, because of our concern, okay, we are not concerned with these expenditures. No. Okay, our main concern is the capital expenditures. Maybe just make a key note here. the cost you incur in order to maintain the existing earning capacity of an asset, okay? You are KQ, okay? You have airplanes. So the amount you incur to ensure that if the life of the airplane is 10 years, okay, or maybe 40 years, okay, the amount you'll be incurring to ensure that the asset does make 40 years, this is instead of that 11 expenditure, okay? However, the amount to be incurring in order to increase the earning capacity, to improve the earning capacity of the asset, okay? You want to increase the life of that airplane from 40 years to 50 years, okay? So the expenditure being carrying, don't forget you're increasing the useful life, you're increasing the earning capacity of this machine. So the expenditure being carrying to increase their life from 40 to 50 in itself, it's classified as part of the capital expenditure, okay? I hope that distinction is a bit clear, okay? I hope it is. As I mentioned, the capital budget is issued, okay? Of course, it's the key step when it comes to the budgeting process, okay? The capital budgeting process, okay, is on the financial analysis, okay? And of course, that's what we shall concentrate more towards, okay? So that's our bit, okay? But of course, the capital budgeting begins all the way from someone coming up with an idea, okay, that as a company, we do require a new van, okay, as a company, we do need to expand to this particular market. Safaricom, we need to be offering a new product in the market, okay, so there'll be someone who will be coming up with an idea that, hey, this is where we should therefore be putting our money in, okay, we'll call the idea generation step, okay. Once we surpass that clear target, we are off that particular step. The next is to make an evaluation, okay. This particular investment that we are proposing, okay, how does it help us achieve our long-term objectives, okay? Of course, therefore, as a company, you do have some objectives you want to achieve, okay? So how does it help you as a company achieve those long-term objectives, okay? You make that evaluation, okay? How does it help us as a company attain our 5-year plan, okay? How does it feature in our 5-year plan, okay, targets, for example, okay? So trying to make that evaluation, okay? Next step, of course, is about financial analysis. If maybe it does help you achieve your 5-year targets, okay, achieve the 10-year targets, okay, well and good. The next bit is now we do the financial analysis of it, okay? How much cash are we going to be receiving from this particular project, okay? What is going to be the cost of this investment, okay? If you're going to use the NPV method, okay, okay, how much is going to be the NPV of this particular investment? What is the payback period if you prefer to use a payback period, okay? Should we invest or not invest in the project, okay? So all that's one part and parcel of the financial analysis step, okay? And of course, lastly, is about trying to, if maybe the step number 3, the one you just mentioned about financial analysis, we consider that the NPV, or the amount of cash we earn, is more than what we spent, okay, in present value terms, then of course we advise the management, hey, this is a good investment. Invest, or let us invest our money in it, okay? Assuming that management, of course, take it up, and of course, they invest in the project. Don't forget, you did make the investment, for example, today, in the year 2020, okay? You are projecting that in the year 2021, you're going to be getting X amount of cash. In the year 2022, the same, okay? So there's a 10-year projection, for example, okay? Now, we have to go back to the drawing board, okay? Compare what was the forecast, what was the projection. Now we are in the year 2022, okay? Have we achieved what we were expecting as at year 2020, okay? So evaluating, going back and trying to make a comparison of the actual performance versus what was the forecasted performance, okay? If the actuals are lower than what was expected, what do we need to do, okay? Because of course you need to ask that question. What should we do, okay, so that we can achieve those targets we had forecasted? Where could we be going wrong as a company, okay? Trying to monitor the progress of the investment, okay? How is it progressing? Are we achieving what was our targets, okay? So that is again simply what we call the capital budgeting process, okay? I think I'll mention later on. But anyway, the key thing you need to know is that what are the features, therefore, of capital budgeting decisions? Okay, what are the features? What are the characteristics of those decisions? Okay, of course, they're not revenue expenditures. Of course, therefore, they will spend a lot of money. Okay, so the initial capital input is going to be high. Okay, in most cases, okay, it's not that you do buy a motor vehicle every day. Okay, as a company, you don't buy delivery vans every day. Okay, you don't buy tractors in case they're involved in construction every day. Okay, so because therefore most of the time the amount of capital required, okay, is quite substantial. That is in case you have to compare with the normal day-to-day expenditures for sure. Okay. Since most of the time you're going to be having that case of is about the future, okay, you're doing a forecast, okay, and of course future has its own risk, okay, and of course the longer we are into the future, okay, a projection for the next 1 month is a bit, we can say that the risk is a bit lower, okay, compared to a projection for the first quarter of the year 2030, okay. So of course therefore as you go further into as the end increase, the number of year increase, of course the risk become higher and higher, okay. But since we are projecting the future, we are making decisions regarding what we are anticipating to have in the future. Of course, the element of risk and uncertainty has to be there. Okay. Then you have what we call a time lag. Okay, that is between the time you invest the money. You are investing in this year, in year 2020. Okay, when do you anticipate to get the money? Most of the time, you don't get the money today. Okay, you're going to invest the money. Okay, and start getting the returns maybe 5 years later. Okay, assume you're involved in the case of mining of oil. Okay, I think you've seen this company, the Total Oil. Okay, so I think it started mining in the year 2012, 2011 there. Okay. Have they been able to get enough cash flow from the mining of the oil? Okay, I don't know, but I don't think we have not gotten that substantial bit of it. Okay, so of course the risk is going to be high. Okay, and most of the time you may end up investing and taking longer. By the time you're going to start getting money, it might be 10 or 20 years later. Okay, so of course you do have to also to take that into consideration. Okay, that you may have to wait longer before the project started generating return to the shareholders, to the investors. Okay, and of course, definitely, yes, that does require priority. Okay, because the company, we have to consider that if we don't invest, okay, or rather, check out the present. Okay, if you're a company, where do you earn your money from? Okay, that your current earners, or rather, the revenues obtained today, okay, is an investment you took in the past, okay. It is an investment that you did decide to invest in the past, okay, which implies therefore, if in the future you don't want to have another stream of revenue, then you must plan where should you invest today, okay. So therefore, the company future is paid on your current decisions, in short, okay. So it does require priority. If we don't invest today, then how do you expect therefore to be earning in future? It will happen, okay. And in some cases, okay, in most cases, the decision may be irreversible. That is, in case you decide to invest in this particular investment, in this particular project, then you have to stick with it until the end. Okay, the decision might be irreversible. Okay, it might occur. Okay, maybe they can be, you can reverse some of them, but in case you reverse it, then you might end up incurring extra losses. Okay. If you buy a motor vehicle today, okay, simple example, if you buy the high-end vehicles, okay, from the showroom, okay, once that car steps out of that showroom, its value is going to drop by 30% immediately, even before you clock, I don't know, let's say 10 kilometers, its value has already depreciated by the mere fact that it is out of the showroom, okay. The same thing applies, okay. Once a car decide to make a decision regarding those capital expenditures, then to reverse the decision might be impossible, okay, if not too costly, okay. Here, well, the exam is going to ask you, by the way, okay, what are the features of capital budget decision, okay. I think we shall try to go through a question bank, because I think there's a time your examiner had asked you that question, okay. And this is the capital budgeting process, okay, which I think I've already discussed with you, okay, but these are the steps, okay, so go through it, then we shall come back. So go through it in the next 2 minutes, may also. Okay, so that's the capital budgeting process. Of course, when it comes to the appraisal, okay, or the company want to make a decision as to whether they ought to invest or not, of course, the concept of relevant and irrelevancy has to come in here, okay? Because not all cash flows that do occur should we consider. There are some cash flows that we ought not to consider when appraising or when making the decision as to whether to invest or not to invest. Okay. Therefore, the cash flow that we should consider are only those cash flows that are incremental, okay, and they occur in future, okay, incremental and futuristic, okay. Now, what's the difference? What are those two terms mean? Incremental, okay, or an increase, okay, not always an increase. An incremental is a change in the current status, okay. A change can either be an increase or a decrease from the current status, okay. If, for example, currently you do pay for electricity, assuming a month you pay, let's say, 100,000, okay, as a company, okay. So every month the amount of electricity you pay is 100,000. If we are to buy this new machine, the cost of electricity will decrease from, let's say, 100,000 to, let's say, 85,000. Okay, so therefore, what's the incremental savings? It is 15,000. Was used to incur 100,000 per year, per month. Now you only incur 85,000. So every year you save therefore 15,000. Okay, that's a plus. Okay, there's a saving. Okay, is a decrease in the company cost, a saving to the company. Okay, and since this saving is occurring in the future, that is once you you buy this machine, then they can say, well, that saving is an incremental saving and is occurring, and it is occurring in the future. Therefore, it is therefore relevant for making the decision. Okay, it must be occurring in the future. If it has already occurred, is a past cost, is a past cash flow, then it is therefore irrelevant for the decision. Okay, we ought not consider it when appraising the investment. Okay, so it must be occurring not today, can be occurring today. Okay, but should not have occurred yesterday. Okay, it must be occurring today going forward. Okay, that's called futuristic. Okay, it must be incremental. And the term incremental does not mean an increase. Okay, so take that a note. Incremental does not mean an increase. It can be a decrease in something. Okay, either again we receive less money. Okay, but still an incremental. Okay. The cash flow we ought to consider, the relevant cash flow that we ought to consider when it comes to the appraisal of the investment. Okay, one of them is the initial cost. Okay, assume the investment you want to put your money in is a machine. Okay, you want to buy a new motor vehicle, you want to buy a new equipment for the factory. Okay, so the amount to be paying to acquire this delivery van, you pay to acquire this motor vehicle. Okay, the initial cost therefore become part of relevant cash flow. Okay, because you are deciding you want to invest in a project, therefore you must pay something for sure. Okay, this is done for free. Okay, therefore the cost you be incurring to invest in the project, okay, is referred to as the initial investment cost, and that will be including the purchase cost of the asset, for example. Okay, the installation costs, okay, that you'll be incurring, the import duty in case you are importing this particular machine, the VAT you'll be incurring. So all those incidental costs, okay, the carriage inward costs you'll be incurring. So all those costs, okay, that are meant to bring the asset into its usable format, okay, you therefore become part and parcel of initial cost, and this therefore relevant cash flow. Okay. Then cost, we have the cost of production. The cost of production. Now this machine you have bought, okay, what is it going to be doing? It will be used to produce some maybe products. Okay, the cost will be incurring, okay, in producing those products. Okay, the cost will be incurring. The raw material will be incurring. The payment for wages. Okay, the overhead cost will be incurring. Okay, so all those costs will be incurring in producing the units that are being produced by that machine, for example. Okay, therefore they ought definitely be considered as we appraise the investment. We appraise this new machine. Okay, the cost of production. Clear?
Clear.
Great. Now you also have what called the operating expenses. Okay, we ought to consider therefore called cash flow. We ought to consider is the operating expenses. Now this machine you have just bought, don't forget, it will be using electricity, maybe, okay, to be using fuel, okay. Okay, the cost to be incurred, that cost to be paid for the running of the machine, okay, in itself is not a cost you used to pay before, but now you'll be paying because you bought the machine, okay, because you bought this particular equipment, okay. Either way, this machine requires repair, okay. It is not a repair-prone machine. It requires maintenance, okay. Therefore, the cost of incurring to maintain that asset in its good working condition. Therefore, you ought to consider it when it comes to the appraisal of the machine, okay. So the cost of incurring to ensure that you are able to ensure that the machine does remain in usable format, okay. Repair you'll be incurring along the way, the cost of fuel you'll be incurring, all those need to be the rent you pay, okay. This machine need to be installed in a new factory, okay. The new factory you have to pay, for example, the rent charges, okay. Okay, so all will come there for part and parcel of cash flow that we ought to consider. Then have called the opportunity cost, okay, the so-called the imputed cost, okay. Now, you may have cases, okay, where as a company currently, you do have a factory, okay, and maybe the factory is not 100% utilized, okay. So we have what we call a spare capacity, okay. So what about the spare capacity, okay? Maybe you do lease out to a third party, okay. You have two factories, okay. You only use one, okay. So what do you do the next one? You normally lease it out to a third party. So you earn rent for it, okay. So therefore, that's second factory does earn for you rent, okay. But since now you have decided, okay, that you're going to buy a new machine, and assume that this new machine, this new equipment, you're going to be installing it in the second factory, okay. So don't forget now, since you're going to be installing it in this second factory, you need to, in quote, kick out the current tenant there, okay. Because don't forget, current is being used by someone else, okay, by that party. But now, since you want to use it, what do you do? In quote, you have to kick them out, okay. Therefore, the rent used to earn on that particular factory, that particular space which now you want to use, okay, is lost. Okay, you will be earning that rent going forward. Okay, therefore that's a lost benefit. Okay, therefore when it comes to the analysis of this new machine, you have to consider: I used to earn rent on this machine. I want to be earning going forward. Therefore, we have to consider it as a cash outflow for this new machine. Okay. It's money out of the business, which you used to earn, but now you'll be earning, okay? Maybe another case could be a scenario where, as a company, you do have workers, okay? You have two projects. You have the current project, okay? Or in factory, okay? Now, since they have bought this new machine, you do require to transfer some of the workers from the old factory, in quote, to the new factory, okay? So since you have transferred some of your workforce, okay, maybe in the old factory, there'll be a drop in the production because you have taken some of the employees from the old factory to the new factory, okay. So there may be a drop in the production in the old factory, okay. The drop in the production, okay, because you have transferred the employee from the old factory to the new factory, for example, okay, they become part and parcel of the cash outflow for this new investment, okay. Because you'll be earning less from this old investment, from the old investment because of this new investment, okay? So we have to consider it as part of cash outflows for this new investment, okay? Clear?
Yes.
Okay, that is good. Then of course you have to consider the taxes you'll be paying. Don't forget, assume that this new machine you have just bought, okay? Of course you bought it because it's going to make profit, okay? Now assume that 1 year down the line, okay, you're making profit, okay? Of course, KRA is going to ask you, hey, you made profit. Here's the tax due, okay? You made 10 million worth of profit. Therefore, how much do you pay? Here's 3 million worth of taxes, okay? You're paying it as a cash outflow, and you're paying it because you're making profit from the new machine. Therefore, you have to consider it, therefore, as a cash outflow the year when you do pay that tax. Okay, so you have to be careful by the timing of tax. The timing of tax. When do you pay the tax? Okay, do you pay a year later or do you pay the same year? Okay, you have to be very careful with the tax. Okay, because if you're going to be using discounted cash flow, a 1 year difference between when the timing of cash flow can have a huge impact on the present value of cash flow. So be careful, be very precise. When does this cash flow occur? Okay, so you have to be quite careful. Then you have the case of what we call the redundancy payment. Okay, assume that the new machine, okay, the company is replacing the old machine with a new machine. Okay, so this is not like the company is buying a new machine to run concurrently with the old machine. Okay, so the company is buying this new machine to replace the old machine. Okay, so it's a replacement. Okay, now assume that this new machine, okay, it is more advanced in terms of technology. Okay, so it is more automated. Okay, so in the old machine, the company used to employ, let's say, 20 employees to manage and produce the units, to manage the machine. But since this new machine is more automated, you don't require 20 employees. You only need 10 employees, for example. Okay, or you require maybe 5 employees. Okay, this new machine is more automated, so therefore it's more, it's not labor intensive. Okay, you have to use that term. Okay, therefore the old machine was requiring 20 employees. The new machine requires only 5 employees. Now the question remains, what do you do with these 15 employees? Because that's now excess. Because you only need 5 employees, but now you have 20 employees. So what do you do with those 15 extra employees? What can you do with them by then?
You lay them off.
Okay, that's one of the possibilities. You can lay them off. Okay. Now, do you just lay them off? Or do you just tell them tomorrow there's no work?
No, it has a procedure.
It has a procedure, no? Really a process you need to follow. Okay. And most of the time, you need to pay them for example, at least. Okay. So you declare them redundant, but pay them in advance for 3 months. Okay. So if, for example, you want to declare them redundant, you want to lay them off today, you'll be paying for them for the month of September. Okay. You pay for them for the month of October and the month of November. So you pay for them, for example, 3 months in advance. Therefore, that's a cost you have incurred. Why? Because you have bought this new machine. Therefore, those payments you're making as you declare the employee redundant, okay, they've become part and parcel of cash outflow of the investment. Because you are paying for it, you're paying those employees because you bought this new machine, okay? Then you have to call the residual value. The residual value. The residual value is simply the scrap value, okay? It's the scrap value, okay? That may be at the end of the life of this machine, which you have bought in the year 2020, okay? Its life comes to an end in the year 2030, okay? But it can still be used to do, it can still, the market still wants it, okay? Now, what do you do in the year 2030? You go to the market, tell the market, I have this machine, would you want to buy it? The market can buy it as a scrap, okay? The market can buy it as a second item, second machine, okay? So the amount to be receiving from the disposal of that machine at the end of its life, okay, becomes therefore a cash inflow the time you receive it, okay, because a cash inflow the time when you dispose the machine, okay, the residual value, okay. Then you have the cost of decommissioning. Yes.
Excuse me, sir.
Yeah, sure.
Kindly repeat on the residual value. You are breaking. I didn't get it.
Okay. The residual value is like the disposal value. Okay. At the end of the life of this machine, okay, the machine you have bought in the year 2020, you may decide at the end of year 2030, we need to sell it off. Okay. So the amount to be receiving from the sale, from the disposal of the asset in the year 2030, okay, is referred as the residual value, the scrap value, the disposal value. And you're receiving it because you bought a machine, okay? Therefore, it becomes therefore a cash inflow in the year 2030. Clear?
Yes, it's clear now, thanks.
Okay. Then you have to call the cost of decommissioning, okay? Decommissioning cost, okay? Now, what is cost of decommissioning? Not at the end of the life of the investment. Let's assume the case of you're involved in mining, okay? Maybe a classic example could be the case of mining of oil in the open sea, okay, in the open ocean, okay? Now, there could be instances where there could be oil spillage, okay, where the oil spills over. Now, as a company, if there's going to be some issue, this oil has spilled, then you have to repair the damage, of course, to the environment. Okay, if you're going to be Bamburi, you're the one who mines cement. Okay, you do extract them from the ground. Okay, the limestone. Okay, so then of course, once you have mined that limestone, you have to you can't leave the holes open. Okay, because they can be dangerous. You have to make good for the environment. Okay, now the cost will be incurring. Okay, to repair the damages you may have, for example, made to the environment. Okay, the cost will be incurring as a company to make good for the bad you have done to the environment. Okay, is what we call the cost of decommissioning. Okay, the decommissioning cost. Okay, so therefore you're paying for it because you choose to invest. Okay, therefore count therefore part of relevant cash outflow that year when you pay for it. Okay. Then of course you have working capital. Okay. The machine you have just bought, okay, you have to invest. Since you do want to produce some units, okay, you have to invest in working capital. You have to buy raw material. You have to buy, you have to incur some expense to produce, to convert those raw material to work in progress, okay, to finish good. You may have to sell to the customer on credit. So it means you are investing in your customer, okay. Suppliers may also be investing in you. So the net amount of investment, okay, that is simply the current assets you have invested minus current liability. Okay, simply the net working capital, okay, is a cash outflow when you invest in it. Okay, if you be investing, okay, in the year 2020, okay, you are deciding to invest in the project today. Okay, so you have to buy raw material, and by extension, work in progress. By extension, finished good. By extension, you make sales on credit. So you are investing in working capital. So it is actual money you are investing. Okay, of course, it might be in form of credit, but it's actual money. Okay, someone had to pay for it. Okay, so the working capital, the year when you pay for working capital. Okay, therefore that's a cash outflow. Okay, in the final year, okay, assume that the project comes, if the end of the project is year 2030. Okay, it is 2030. Okay, now what happens there? We have raw material, okay, at hand. What do you do with that raw material? You have some customer who still owe you money by the time you're closing down the project. What do you do as a company that year 2030, in relation to working capital? What do you do?
Come again, please, sir.
If already you did invest, you did pay for raw material in the year 2020, okay? Don't forget, you don't need to invest extra money, okay? Unless there is a need, but you don't need to invest extra money. Once, for example, in year 2020, you have put aside 10 million just for the raw material, okay? So don't forget, you buy raw material, okay? Convert products, convert to sales, then cash will pay you, then the cycle goes on, okay? So you don't, once you have invested 10 million, you don't need to invest any extra until the end of the life of the project, isn't it?
Yes.
Okay, so you don't need to invest anything extra, okay? You may need, but not a must, okay? So which implies, therefore, you already have 10 million security. Is that clear?
Yes.
Now, what do you do with that 10 million at the end of year 2030? Because you are closing the project then. What happened?
You will recognize it as an asset. You will recognize it as an asset.
You need to recognize it. Already have made the recognition, isn't it? Most
Yeah.
people, you'll be having the inventory, receivables, work in progress. So already have done the recognition. Now we are in that you need to recognize it, isn't it?
Yes.
How do you recognize it? In short, that working capital becomes a cash inflow because you no longer require working capital. That's the end of the life of the investment. So already have 10 million in circulation. So if, for example, you have raw material already remaining, what do? Dispose them off. Don't buy another one because it's coming to an end of the, it's like stock clearing. The simplest could be in case you do have sell some merchandise, okay? And now you want to close down the investment. What do you do with your merchandise or you already have? You clear them off. You dispose them off, okay? Therefore, in the year 2030, the amount you have invested towards working capital becomes a cash inflow then. If you didn't invest 10 million, you recover your 10 million in the year 2030, okay? It's like you're trying to clear off the stock so that the project can come to an end, okay? So all your initial investment you made in working capital becomes a cash inflow then. Clear?
Yes.
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 Or the key concern could be a case where the company, you're not starting from scratch, okay? For example, you want to invest today, year 2020, but already the company has made some previous investment, so the company has another machine, okay? So all we are needed to do is to top up, okay? Because this is not a new investment. You have some other similar investment you have already made, okay? So what becomes therefore the relevant cash flow in relation to working capital is the extra investment making, okay? So if, for example, the company did invest in the year 2019, it had a working capital of 3 million, okay? 3 million. Now in the year 2020, if we choose this investment, we need to increase from 3 million to 5 million. Therefore, in the year 2020, how much do we invest? The extra, which is equal to the 2 million, the incremental, the 2 million. Okay, therefore, this 2 million is only what we need to consider towards working capital. Okay, that's why you have to be quite careful. That we only consider the incremental if we have a case where the company already has a previous investment they made on that particular investment, a similar investment before. Okay. Clear? Okay, take note of this.
Excuse me, sir.
Mm-hmm.
Kindly repeat, pardon that particular concept, what you just tried to explain. Yeah.
Okay, assume that the company, this is a machine we are going to buy, but already the company has other similar investment in relation to that particular investment. Okay, so it's not a new project altogether. Okay, the company bought, let's say, delivery machine. Okay, assume that the company has a machine. So in the year 20, right? So in the year 2019, the company bought machine 1. The amount they invest towards working capital then, okay, was, let's say, 3 million. Now they want to add another machine, okay, so they're adding, okay, machine 2, we'll call this M2, machine 2, okay, and the total working capital required, okay, is 5 million, okay. Therefore, the question is, if the company was to invest to buy this machine 2, how much working capital should they be injecting to the projects, to the company? They need to invest an extra 2 million, isn't it?
Yeah.
Now, therefore, what we ought to consider when appraising machine 2 is not the 5 million, but the 2 million. Because machine 2, what is extra the company should be investing? Or 2 million. already the company has already invested 3 million. So this is like a past cost. This is like a sunk cost. So what is relevant for machine 2 is the 2 million. Clear?
So in this particular company, we are still using the machine 1 also. We've just bought a new machine to put additional to the first machine.
Yes, so is the machine 1 and machine 2 will be operating together, not like it's a replacement, okay? So the machine 1 and 2 will be working together.
Okay.
Yeah. Okay. Now actually with that concept, because we have mentioned it, now assume that the company is replacing machine 1 with machine 2. Assume the company is replacing machine 1 with machine 2. So the machine 2, its life is coming to an end once you buy the new machine. What should we consider as the increment working capital? Should also be the 2 million. Okay, it should also be the 2 million. Why? Because the 3 million, which we require on a machine, don't forget, assume that in machine 2, the total working capital required for machine 2 is the 5 million. But don't forget, already the company has made an investment of 3 million through machine 1, even though its life is coming to an end. Okay, so the company, therefore, you don't need to invest 5 million because already you have a previous investment which you made of 3 million. So you only need to top up the 2 million. Clear?
And then a question on that particular concept. So what about, for example, the first machine, it's being disposed. There is a certain amount that we've received from the disposal. And then now we have purchased now the M2 for a replacement. How do we deal with that?
Okay, let me just go back to initial capital. Okay, so the initial capital, okay, so because if it's a replacement question, we have machine 1 which we bought in 2019. Okay, we now want to buy machine 2, costing. Assuming the machine 1, we bought machine 1. Allow me just to have a better area for marking. Okay, so just put it into context. Okay, machine 1 was bought in 2019 for a cost of 10 million. Okay, now in the year 2020, we want to dispose it off. Okay, because we are replacing it with a new machine, and if we are to sell it off to the market, you're going to get 6 million. Okay, so the market is going to give us 6 million from the sale of machine 1, and here we want to buy machine 2. The cost of machine 2, which is occurring today, 2020. Assuming to be equal to 15 million. Okay, therefore, the initial investment we require, okay, is 15 million. The amount you need to pay for machine 2, 15 million. But you're going to get some money from the sale of machine 1. You're going to get 6 million. Okay, therefore, minus 6 million. So the amount you need to invest, therefore, in the year 2020 is 15 million net of 6 million. Therefore, the net investment required in year 2020 is 15 million, which is 15 million less amount we receive from the disposal of machine 1. Clear?
So in this case, if, okay, the 9 million is going to be like the incremental net working capital.
No, this is not. This is the cost of the machine. This is not working.
Or the cost. Or this is the cost of machine.
Yes, the cost of the machine, not working capital, but the cost of the machine.
But now on the working capital, we are still going to have an incremental of 5.
Still the same case we discussed about working capital. That in 2019 you did invest 3 million towards this working capital. Working-capital. Now in the year 2020, under the new machine, the extra this machine is actually it is producing more units. Therefore, you need to invest more towards working capital. As in machine 2, the total working capital required, okay, working capital required. This is year 2020. It's year 2020. Okay, is equal to 5 million. Okay, they require 5 million. But don't forget, already under machine 1, you have a previous investment of 3 million. Okay, you have already raw material. Okay, worth, like for example, 3 million. So therefore, under machine 2, you're going to pick from where machine 1 left. Therefore, what's the extra you require to invest? You require to invest an extra of 2 million only. Because already you're picking from where you're not picking from scratch, in short, okay? But you're picking a place of continuation.
Okay.
The working capital required at the machine 2, the required is 5 million, but what is going to be relevant is the 2 million, okay? As a cash outflow of 2 million. Clear?
Okay, yeah, it's clear, thanks.
Okay. Now assume, okay, let's just continue that working capital. And now machine 2, its life is coming to an end in the year 2030, okay? Machine 2 life is coming to an end in the year 2030. The company does not want to buy a machine 3, okay, in short, to replace machine 2. So assume they want to add that investment altogether. Don't forget, already the company has total working capital investment of 5 million. That is 2 million that was invested in year 2020 and 3 million invested in year 2019. So therefore, by the end of year 2030, the company total working capital is 5 million. Therefore, they recover the entire 5 million. Okay? The company will be recovering the entire 5 million, the 2 million and the 3 million here. Okay? Therefore, cash inflow to be recognized in year 2030 is 5 million. Okay? Even though in year 2020, the amount was recognized was only 2 million. Okay? Hope that's clear.
Yes.
Now, if in the year 2030, the company is going to replace machine 2 with the machine 3, do we require to dispose of the working capital? In the year 2030, the company want to buy another machine 3, okay, and the total working capital required at machine 3 is 5 million. Do we require to dispose of the 5 million which we have here at the year 2030? Do we need to recover? No. We don't need to. Therefore, in the year 2030, there will be zero working capital recovery. Okay, there will be no cash inflow in terms of working capital. Okay, so in case the company will be replacing machine 2 with another new machine, and machine 3 in the year 2030. But in case there is no replacement, okay, here we don't have replacement, then we shall be recovering the entire 5 million. Yes, Zita.
So I wanted to ask, I've understood the concept, but I'm wondering in terms of like in real life, I don't understand how it is an inflow, or is it because we had provided for it and deducted already? I don't understand how it becomes an inflow even if we've...
Assume that you own, what investment do you own? Assume you make cake, isn't it?
Yes.
Assume that you do bake cake. I'm trying to give a very simple example. Assume that you do bake cake, isn't it? And in the investment, you did buy, what is what making cake? I think wheat flour, what else? I don't know. Assume that you did buy all those raw materials that are required to make cakes, isn't it?
Yes.
Now, your investment or your project or your company did start in the year 2010, okay? So you did start your investment in the year 2010. How much did you spend to start off the business? Not the to buy the flour, to buy all those ingredients. How much did you spend? Pick a figure.
1 million.
1 million. So you spent 1 million, okay, to buy all those ingredients, to buy the inventory, to buy the raw material, okay. Now you want to close down this business in year 2020. Don't forget, already you have raw materials worth 1 million, isn't it?
Yes.
Okay, you have to convert those raw material to cakes. Now, what do you do with that raw material? You have 1 million. Because you have it, it's worth 1 million, that particular raw material you have currently in the business. What do you do with that raw material?
Oh, yeah, you sell it. You
sell it to the market, okay? And assume the market is going to give you its worth. Therefore, the market in 2020 will give you back your 1 million, isn't it?
Okay, yes.
So the 1 million count, therefore, a cash inflow, okay?
Okay, but, you know, when you were talking about machines, in my head I had pictured probably like the machine at the end of its lifespan, it's now useless.
It's what?
I'm saying, like in the case for machines,
Mm.
you had said you had put it as if it's the lifespan of the machine,
Mm-hmm.
which it's come to an end, like at 2030 we need to buy a new one. So if we need to buy a new one, who will buy that old one? Is it still useful?
The new one or the old one?
The old one, sorry, the old one.
On the old one, you can see the market can decide that, hey, this particular motor vehicle, it is true you have used it for the last 10 years, but it still has a good life. It can still have a life for another 5 years. So the market can still buy that particular secondary market. Yes, the market can buy it for sure.
Oh, okay.
In case you have a motor vehicle that is 15 years old, is it worthless? No. The market may pay you something. You might sell the market. You can just simply go to the market this motor vehicle with the following specs. The market is willing to pay for it for sure. So the amount to be receiving from the sale of that motor vehicle in the year 2030, the scrap value, okay, becomes therefore cash inflow the year when we sell that motor vehicle.
Okay.
Yeah, it's clear.
Yeah.
Okay, fair enough. Okay, now there's some cash flow that we ought not consider when it comes to the appraisal of the investment, okay? And one of them is the interest cost, okay, or the interest charges, okay? We ought not consider them, okay? Why? Because we are going to consider them, okay, under the cost of capital, okay? Don't forget, as I mentioned, to get the present value, you discount them at a given rate, okay? 10% per year, 20% per year. So therefore, that discounting rate includes the cost, includes the interest charges, okay? It includes the interest charges. So therefore, we are not going to be subtracting the interest you pay for the bank loan, which you use to buy the machine, because it is taken care of by the discounting rates, which implies that in case you're going to be subtracting the interest you pay from the cash flow from the project, then that's wrong, okay, because you'll be double counting for it, okay? You will be double counting for it, okay? That's why in quotes, we consider it as irrelevant, even though it is considered for by the discounting rate, okay? The rate you use to get the present value of the cash flows, okay? Then you have the market research as well as cost of development, okay? Market research. Now, why are these relevant? Let me just give an example so you can see the concept, okay? Assume that you decide to hire some consultants, okay, who are going to make an evaluation of the investment, okay? They can, maybe you want to launch your Unilever, you want to launch a new, a new Toyota, okay? A new soap in the market. So you have some consultants, okay? Is this innovation going to be worth for us? Is this particular new product going to be worth for us? Okay, so let's also tell you the market is good, the market is bad. Okay, if you launch this product, then it's going to be a drain of your money. Okay, so you hire researchers to do that before you commit the money. Okay, so in that case, therefore, since you're going to be hiring researchers, okay, to assist you to make the decision, okay, as whether to launch the investment, the product or not, okay. If they advise you, okay, if they advise you that this is not a very good place to invest, to put your money in, what do? Do you pay them or don't you pay them? Do you pay the consultants?
You pay them.
You pay them.
Yes, you pay them.
Therefore, that cost was committed. Because don't forget, the relevant cost can only be relevant if it is going to be pegged on you making the decision. But the research costs are not pegged on you making the decision. Okay? Whether you decide to go ahead with the investment or you don't go ahead with the investment, you have to pay the consultant. That's why you pay that fee is irrelevant. Okay, the payout you're going to pay to the consultant is therefore become part of irrelevant cash flows. However, the cost you'll be carrying to market the products. Okay, the cost you'll be carrying to market the products. Okay, you have already you already made the investment, okay? You have said to Unilever said to let's launch this investment. They are causing to market it, okay? The cost will be carrying to market that particular product become therefore a relevant cash flow, okay? But the market research costs were irrelevant, okay? Then the cost of existing machine, okay? You bought a machine in 2019, you paid 10 million. That's a past cost, Okay, you paid it already, 2019. So we don't consider when we appraise it, the new investment. Okay. There are no costs that are allocated, okay, or costs that are absorbed, okay. I think you may have done that already in MA, okay. Why are they absorbed? Because they are incurred elsewhere. They are not incurred by the investment, okay. They are just being allocated to the project, okay. Cost of the CEO, whether you invest in the machine or you don't invest in the machine, you have to pay the CEO either way. Okay, so the cost of the CEO or the admin costs that have been allocated to the match projects are therefore irrelevant, okay, which therefore should not consider when appraising the investment. Because whether you do invest or you don't invest, that cost should have to be incurred either way. Okay, that's why those costs are therefore irrelevant. Then you have the depreciation. Okay, we have depreciation, accounting depreciation. Okay, they are also irrelevant. Why? Because what is depreciation? Is an allocation of cost over the life of the asset. Okay, you bought a machine cost in 10 million. So every year you depreciate 10%. So you are simply allocating that 10 million over the life of the investment. Don't forget, you have already taken care of the cost in year zero as the initial investment cost. Okay, therefore you can't go ahead and start accounting again. Okay, that's why account depreciation therefore an irrelevant cash flow. Okay, okay, it's not even a cash flow. Okay, okay, it's a non-cash item. Okay, it's a non-cash item. There is no any actual cash movement. You paid for the asset in year zero, so therefore any further depreciation on the asset is not, there is no any movement of cash. Okay. Then lastly, we have the dividends. Okay, they assume the investment was financed by shareholders, and you promise them that every year I'm going to pay new X amount of dividends for you finance the investment. Okay, sounds irrelevant because it is therefore cash flow is therefore relevant. However, it is taken care of by the cost of capital, the discounting rates. Okay, and that's on the introduction towards relevant and okay, not introduction, it's a recap of what you may have discussed in MA. Okay. Clear? Okay.
Clear.
We go straight to the methods. As we mentioned, we see that you can appraise the investment using two main type of techniques. Okay, the discounted and the non-discounted. And I think we mentioned the key distinction. And take a minute to go through them. Now, I've seen there's a question by us. Sarah was asking a question. Now, Sarah, did I define it well? I don't know.
Okay, sorry to take you back, but it's like I didn't understand the incremental because for me, I took it as an increase.
Okay. Okay. Thank you, Sarah, for that. Now, by the way, in case you see, because I rarely go to the chat that often, but in case you see that I haven't answered your question, you can raise your hand up. So because I can see that icon for the hands up, I can see it very clearly. So anyway, let me just explain to you. Incremental, I just will give an example. Assume that we have cost of electricity, okay, machine 1, machine 2, okay, and on machine 1, the amount you be, okay, so this is a replacement. We bought this machine in 2019, this machine is getting bought in 2020, and on machine 1, the company used to incur a cost of, let's say, 100,000. And machine 2, since it is in quotes, is a bit bigger, it is producing more units, so you pay more electricity. And assume that you'll be paying 120,000. Therefore, when appraising machine 2, we should be considering the extra cost. Don't forget, because whether you invest in machine 2 or not, you have to pay 100,000 because you have machine 1 already. Therefore, what is therefore going to be relevant for machine 2 is the extra cost. When appraising machine 2, we only consider the 20,000. The extra cost will be incurred. Clear there?
Yeah, clear.
Now, assume that machine 2 is automated. Okay, therefore you don't require a lot of workforce. Okay, therefore the labor cost you used to pay the employee here. You have 10 employees. Okay, so here you had 10 employees. Okay, so you pay $1,000 per employee, and you have 10 employees. Okay, the total cost you used to pay was $10,000, isn't it?
Yes.
Assuming machine 2, that machine 2 is more advanced, so you only require 3 employees, but the pay remain the same. Okay, so therefore it'd be 1,000 times 3 employees to get, therefore the pay you make to this employee to be $3,000. Therefore, how much do you save per year?
7,000.
Therefore, you save 7,000. So this is a decrease in cost, but this is therefore a relevant cash flow we should consider when appraising machine 2. This is an increase, which we should also be considering. So therefore, this is incremental, and this is also incremental, even though this is a decrease.
Decrease.
This is an increase, isn't it?
Yeah.
Okay, that's let's say the incremental. No, but it's about a change in status. Because in case, for example, the cost of labor was still 10,000 here before, and even after that it will be 10,000. Therefore, the 10,000 here is irrelevant because even before the machine 2 was bought, you used to pay that cost. Okay, therefore here we have 0. But here, since it is decreasing from 10,000 to 3,000, therefore we have a saving of 7,000.
Right. Thank you.
Okay. Okay, take a minute to go through this. Now, as I mentioned, the payback period, it's simply how long do you take as a company to get back the amount of money you spent on the investment? You have spent 10 million, okay, to acquire this machine, okay. Now, how long do you take to get back the 10 million from the cash to be generated by that machine? Okay, that's what we simply refer to as the payback period. Okay, and of course, the longer you take, okay, the less valuable that investment is. Okay, so in case you have a project that has a shorter payback period, the more valuable it is to the company. Okay, so if we have two competing projects, okay, which you have take either project A or project B, of course, you take the one that is going to give you back your money sooner than later. Okay, so in case you have two what referred to as mutually exclusive projects, of course, you take the one that is going to give you money back a bit earlier than the other. Okay. If we have what we call a target payback, okay, a period where the company management can say that we are only going to invest in projects where we do get back our money within 3 years, for example, okay, and this investment, it is paying you back within 2.5 years, then therefore you accept it. It is paying you back within the agreed upon time of 3 years, okay. If it goes beyond, let's say to give you 3.7 years, then of course you reject it. It is beyond the agreed upon time of 3 years. Okay, and that's how you appraise at a payback period. Simple as that. Okay, that's referred to as the payback period, and you make a decision based on whether the projects are exclusive or whether we have a target payback period. Okay, that's referred to as the payback period. Okay. Okay, I hope the explanation is clear.
Excuse me, sir.
Yes, yes.
What reason will you use to back up picking a shorter payback period for project that with different values? For example, project 1 has an estimated value of, let's say, 1 million, and project 2 has an estimated value of, let's say, 500,000. But the payback period for project 1 it's 2 years and the other one is 1 year. Why will I pick in the basis of a shorter payback period while the values are different?
Well, the values are different.
Yes.
Thank you for pinpointing that. Now, that's actually one of the drawbacks of this method, that it ignores that, okay? It ignores the present value of cash you'll be getting, it ignores the amount you'll be spending on the investment. So all those are thrown under through the windows, okay? So the only thing that we consider is that we consider payback. I agree that it's one of the key major drawback of this method, okay? That ignores that A might project might give you 2 years. The cost of A could be let's say 100,000. Okay, project B gives you back money within maybe 1 year, as you're given us in that example. However, you're going to get the amount of initial investment required in B is 10 million. Which do you have that money? You may not have that money. But now that is ignored when it comes to this particular method. Okay, it becomes one of the key drawback of this method. Thank you. Always clear, Michael.
Yes, it's clear. It's clear. Yeah, now it makes sense.
One of the key drawback of this method, it ignores the amount of the initial investment that was required for that particular project. I guess we'll do an example. I hope it's clear. I think I'll do an example here. Okay, so go through this. I'll do X, then you do Y and Z. So here, let me do some correction. So this there in 100 million, the initial capital is 100 million. And so it can be in shillings. So let's just use shillings, for example. Okay, these are not cash outflows, these are cash inflows. Okay, and all of them, they are in million. They're in cash shilling, but in million. Okay, let's do X together. So the initial investment for either of those projects, X, Y, and Z, you've been told is 100 million. And we need therefore to make an estimation. How long does it take for the government, how long does it for the company, okay, to get back the entire 100 million, okay, based on the cash to be generated from the investment, okay. So I'll do Y, I'll do X, and then you attempt Y and Z. So let's do X together. Now the initial investment, okay, of course, had a million. So let me just call here period. Or this is year. Year 0, year 1, year 2, year 3, year 4. Then the cash flow for each of the period. Year 0 is today. So we have invested 100 million, so negative 100 million. Okay. Then year 1, you have that 5 million, that 5 million every year, that 5 million, that 5 million. Then here I can have another column here, cumulative cash flow, to determine how much is remaining. Year 0, what is remaining is the amount you've just spent, 100 million. Then year 1, you get back that 5. How much remain? So again, you need to recover 100 million. Year 1, you get that 5. How much remain? 65 million. 65 million remains. Year 2 is you get back that 5. How much remain? 30. 65 minus that 5.
30
million remains. Okay. Now, at the end of, don't forget, year 3, you get that 5, but all you required was 30. Okay, therefore, you're going to get all your money between year 2 and year 3. Okay, therefore, we can say payback for this investment will be 2 years, okay, plus a few months. Because before year 3 comes to an end, you've already gotten back your 30. Because don't forget, you need 30, but you're going to get from that 5. So you're going to, before the year comes to an end, you've gotten back all your money. Therefore, the amount of money you're going to get, you need 30 million, but the amount to be earned from that 5 million, which is going to be earned in year 3, you can convert this into months. So to convert them into months, 12 months. To give us 2 years, and how many months?
Oh, 10 months.
2 years and 10 months. So we're going to get the entire 100 million at the end of year 2 and 2 years and 10 months. I hope it's clear on the process. Quite simply, the use of cumulative figures here. Is it clear?
Yes, it is.
Yes.
Okay, that's good. So you do for Y and for Z. Do for Y and for Z, you make a decision, and we shall pick there next time. I hope you have the data for X and Y. That's X, and you have Y and Z. Same process, okay? Okay, so we shall meet on Wednesday. Okay, don't forget, do that bit, do for Y and do Z. Okay, then make a decision. We shall revisit it. We shall revisit it on Wednesday. Okay, then see you on Wednesday.